Welcome to today's explainer. Think back to your high school or college years for a second. You probably learned about mitochondria, algebra, maybe even the French Revolution, right? But did anyone actually sit you down and teach you how to build wealth? Did anyone explain how the stock market actually works? For most of us, the answer is a resounding no. The financial world can seem like this exclusive VIP club guarded by complex jargon and intimidating charts. Well, today, we're tearing down those gates. Consider this your interactive, quick study guide to mastering the absolute basics of investing. We're going to take you from a complete beginner to a confident investor.
Here's our roadmap for today. Section 1. Decoding the stock market. 2. Why stock prices fluctuate. 3. 4 deadly investing mistakes. 4. Day traders versus passive investors. 5. The ideal patient investor. And 6. A smart long-term investing checklist. Let's get started.
Section 1. Decoding the stock market. What exactly are we trading? Okay, let's dive into this. I want to pose this fundamental question directly to you. What exactly is a share of stock? Take a second to really think about it. When you buy a stock, what are you actually holding in your metaphorical hands?
Well, here's the absolute simplest way to think about it. A share is simply a single slice of ownership in a real-world business. Imagine your favorite booming local pizza shop. The owner decides they want to expand. They want to open 10 new locations, but they just don't have the cash on hand to do it. So they divide the ownership of their pizza business into thousands of little slices, and they sell those slices to people like you and me. The absolutely crucial point here is that when you buy a share of stock, you aren't just buying some random ticker symbol blinking on a screen, you're buying a literal slice of that pizza shop. When they sell more pizzas and make a bigger profit, your slice becomes more valuable.
And that brings us to how these literal slices actually get out to the public in the first place. You'll often hear the term IPO, which stands for Initial Public Offering. Think of this as the grand opening. It's the very first time a private company, just like our pizza shop, enters the public stock market to raise money. They do this to gather funds from massive growth, and in return, early buyers get a chance to generate capital gains as the company expands.
Section 2. Why stock prices fluctuate. The mechanics of the market.
So, why do the prices of these shares bounce around every single day? It really comes down to 3 main drivers. First, basic supply and demand. If everyone wants a slice of the pizza shop because it's suddenly the hottest place in town, the price goes up. If everyone wants to sell, the price goes down. Second, company earnings reports. Every few months, companies have to announce exactly how much money they made. If they completely smash their sales goals, investors get super excited and buy more. Third, global news events. Things like interest rate changes, political events, or global supply chain issues can make investors nervous or optimistic about the entire economy. Now, you've probably heard the terms bull and bear markets thrown around. A bull market is characterized by total optimism. People are buying and overall prices are rising over months or even years. A bear market is the exact opposite. Fear takes over, people start selling, and prices fall. I know it sounds a bit scary, but remember, the market has historically always recovered from bear markets. Think of a bear market not as a disaster, but more like a massive clearance sale on your favorite pizza slices. Dips are actually prime opportunities for the patient investor.
Section 3. 4 deadly investing mistakes. Common pitfalls to avoid. Now, what's really interesting about this slide is the behavioral traps that trip up almost everyone at the start.
There are 4 incredibly common pitfalls we need to look out for. First up, emotional trading. The classic real-world example here is panic selling your investments during a crash. The solution? You gotta stay totally detached. Second is market timing. This looks like keeping your cash sitting on the sidelines, just waiting for the perfect bottom to buy in, which, spoiler alert, is literally impossible to predict. The solution is to invest consistently no matter what the market is doing. Third is chasing hype. This is buying a trending meme stock simply because everyone on social media won't stop talking about it. The fix for that? Stick to the basics. Finally, lack of diversification. A perfect example is putting your entire life savings into one single company. That's a recipe for absolute disaster if that specific business goes under. The solution is to buy broad index funds that naturally spread your risk across hundreds of companies.
I really want to highlight the sheer danger of that first mistake. Emotional trading is like panic selling your entire portfolio during a 2020-style dip, only to miss the record-breaking recovery. When the global pandemic hit in early 2020, the market plummeted. Beginners absolutely panicked and sold everything at rock-bottom prices, permanently locking in massive losses. But the market recovered remarkably fast. The seasoned investors who held their ground, or even better, bought more during the dip, saw incredible gains.
Emotion is the enemy of wealth. And regarding the second mistake, market timing, think of it this way. Trying to time the market, guessing exactly when it's going to hit its lowest point to buy or its absolute peak to sell, is like trying to jump onto a moving, high-speed train. You might get incredibly lucky once, but eventually you're going to get crushed. It's a terrible strategy. Consistency will always beat timing.
Section 4. Day traders versus passive investors. Choose your investing style.
So we have two completely different approaches here. First, the day trader. This is what you see in all the Hollywood movies. It's erratic, it's high stress, and it's driven by minute-to-minute news. Day traders treat the stock market like a giant casino, constantly buying and selling to capture tiny little price movements. The reality, the vast majority of them lose money over time. Conversely, we have the passive investor. This approach is calm, collected, and highly disciplined. A passive investor completely ignores the daily noise in the 24/7 news cycle. They buy solid assets and just hold them for years, letting compound interest build massive long-term wealth. I highly recommend you choose the right side of this equation.
Section 5. The ideal patient investor. The mindset for success.
And this brilliantly illustrates exactly who you want to become. Number 1, they are emotionally detached from daily swings. If the market is down 2% today, they literally don't even blink. Number 2, they focus on decades instead of days. They're planning for retirement, not trying to make a quick buck for next weekend. Number 3, they consistently invest regardless of the market mood. They put a portion of their paycheck into the market every single month on autopilot. And number 4, they entirely ignore the relentless hype cycle on the news and social media.
Section 6. Smart Long-Term Investing Checklist. Your 4-step beginner process.
Bringing it all together, it takes just 4 simple steps to get started today. Step 1, set clear financial goals. You need to know why you're investing. Is it for retirement, a down payment on a house, general financial freedom? Step 2, open a standard brokerage account. Honestly, this is easier than opening a checking account these days. Step 3, buy broad market ETFs or index funds. Remember our rule about diversification? Don't bet your life savings on one pizza shop. Buy a tiny slice of the entire economy. And finally, step 4, hold and contribute consistently. Set it on autopilot, be that patient investor we just talked about, and let time do the heavy lifting for you. I want to leave you with this final provocative thought. As you look at the news tomorrow and you see the inevitable market fluctuations, will you let short-term fear rob you of long-term wealth? You now have the blueprint. You know the mechanics, you know the deadly pitfalls to avoid, and you have your 4-step checklist ready to go. The choice is absolutely yours. Thank you so much for joining me for this explainer. If you found this structured breakdown helpful, make sure to hit subscribe so you don't miss our future deep dives. Catch you next time.